Discussion. Let's talk about feeders. So what is a feeder, and then how you've seen them incorporated? Just, the idea, I think, being if someone has kind of a friends and family circle, they can kind of pool that money together into one entity that can then be contributed into a larger fund so that they have a voice at the table. I guess maybe fund of funds is another way to start talking about this type of structure, but love for you to.
This is a great question, and this is where I see a lot of little club deals, right? Because a large fund, or even a fund that is being sponsored by a veteran in this space, will have a minimum investment number, right? So we're only going to take LPs if they can commit $2 million or $5 million or $1 million. There's always and there's always somebody who wants to invest but can't cut a $5 million check. So they take it upon themselves to go aggregate, 5 or 6 or 10 or 20 other investors who are similarly situated, who want to invest in the fund but can't stroke the minimum. So they're like, well, look, I'll be a GP and I'll create a feeder fund, and we'll aggregate $5 million and we'll invest in the underlying fund. So entirely possible to do, but the number of securities laws that you're going to encounter are significant. So what you are buying, which is the LP interest in the underlying fund, that is absolutely a security. So we've covered that. That's a limited partner interest. That's a security. So your fund becomes a pool of securities because it is acquiring the LP interest. So you, as the ringleader or as the GP of that, has most likely become an investment advisor to a private fund that's investing in securities. And you're going to be an investment advisor. It's more difficult to satisfy some of the exemptions that mineral funds might be relying on to be exempt from being an investment advisor. The higher you go up this feeder fund chain, so to speak, or level, and so you're going to incur a lot of obligations as that ringleader, as that GP, and a lot of cost too.
So those costs are going to be passed on essentially, and drive down returns, which can make it difficult for certain funds to take on feeders. Correct?
That's right. And so just because you're just putting a deal together with just your friends doesn't mean that what you're doing isn't tripping up the securities laws, so to speak. So we work with a lot of investment advisors that are wealth advisors that like to invest in alternative private investment funds, and we help them set up feeders for all of their clients. But they're already an investment advisor, and this is part of their strategy for wealth management. And it makes a lot of sense in those instances. But what I hate to see is the sort of club deal feeder fund, because it's a lot of times not a great decision, particularly for somebody who's not going to be in the business of managing capital, right, on a go-forward basis. If this is your first feeder fund in what you expect to be several feeder funds, and you're going to build a business out of creating and managing feeder funds, okay, maybe, but a one-off is, something that's a lot more complicated than you think.